Hey everyone, welcome back to another FBC video. Today's video is about Graham's intrinsic value formula. Before we begin, let's discuss who was Benjamin Graham. Well, Benjamin Graham actually invented the Graham intrinsic value formula. He was an influential investor whose research in securities laid the groundwork for in-depth fundamental valuation used in stock analysis today by all market participants. His famous book, The Intelligent Investor, has gained recognition as a foundational work in value investing. He's also known as the father of value investing and was the mentor to Warren Buffett, who is widely known as the greatest investor of all time. This may look like a complicated formula at first, but let me explain. Let's go through the formula. V is equal to EPS times 8.5 plus 2G times 4.4 over Y. Let's go through what everything means in this formula. V is equal to the intrinsic value of the stock. EPS is also known as earnings per share, and that indicates how much money a company makes for each share of its stock and is widely used metric for corporate profits. Next, let's go to the 8.5 plus 2G. The 8.5 is a PE ratio of a zero growth stock, meaning it's the PE ratio of a stock that doesn't grow at all and stays stagnant. You add that with 2G, and G is known as a long-term growth rate of the company. I'll be showing you how we can find the growth rate later. Next, we multiply it by 4.4%, which was the risk-free rate of the average yield of high-grade corporate bonds in 1962. And divided by Y, which is the current yield on AAA corporate bonds represented by the Y. So now, let's use the formula in action using Apple stock. So first, we have the EPS, earnings per share, is equal to 12.73. Then we multiply that by 8.5, which is again the EPS of a company which is stagnant and has no growth. And we add that to the growth rate of 2 times 11.45. The growth rate of Apple is 11.45, and you can find that on Yahoo Finance by going to Yahoo Finance, searching up the stock, which is ticker symbol AAPL, and then going to analysis, scrolling all the way down, and we can see in the next 5 years, it's projected to grow by 11.45%. So next, let's go into the 4.4. You may be wondering what this means, so I'll explain it. Graham thought as an investor, they had a choice between putting money in common stocks or into bonds. And you can learn more about stocks or bonds in our previous FBC video, which is under the same playlist, so go check it out. And it was appropriate to take into account the rate of interest paid on a high-grade bond, which was 4.4%. And this was used to determine the intrinsic value. The last step includes dividing the entire equation by 2.44, which is the AAA corporate bond yield. And you can just find this by going online and searching up current AAA corporate bond yield. Now I'll go over why we divide this equation by 2.44, which is the current bond rate. So Graham wanted a minimum required rate of return for investing in stocks. And as you test the formula yourself, you'll notice that bond rates affect valuation. The lower the yield rate, the higher the price. This fact goes back to bond basics. If the yield is low, the price is high. If the yield is high, the price is low. And Graham wanted to design a formula to replicate the same line of thought. Finally, if we equate everything, we get $879, which is the intrinsic value. Now, if we compare that to the current price of Apple, it's which is $373.85, we can see there's a 135% upside, which is a large upside, which means that this stock is definitely a buy. Now, although this is a good resource to see whether stocks are overvalued or not, this shouldn't be the only resource you are studying. There should be different various factors that should be taken into account, and you should be doing your own research to find whether a stock is a good buy or not. Thank you everyone for watching. Make sure to hit the like button and subscribe if you enjoyed the video, and don't forget to stay tuned for our next videos in our stock playlist. Thank you.